I guess that the first, well, the three things we look for in any business that we're looking to acquire is, first of all, profitability. So that's the key thing we look for when we're buying businesses. Our valuations are based on multiples of profit. The second thing is recurring income. So that profit needs to be underpinned by the recurring income. And thirdly, a management team that can manage that recurring income profits over at least a 2-year earn-out period, and ideally beyond that. We're looking for firms which are embracing RDR and want to continue to manage and advise post RDR, but are looking for group support. Generally speaking, our firms run on about 30% EBITDA margin on turnover.
Why is that the level that you're aiming for?
Well, generally speaking, a firm has a level of recurring income, and generally speaking, the business that we look for have new business which covers costs and salaries, and the recurring income is kind of preserved as profit. That's generally the kind of business we're interested in our proposition, I suppose. We're interested in them. So recurring income is important to us, of course, but a good size of new business as well, because ultimately, if your business is at 100% recurring income, the profitability is not going to be there. You need the new business to sustain the profitability on the recurring income. Well, I think it's quite hard. We've been doing this since 2008. We've chatted to about 250 firms so far, and we've just made our 22nd acquisition. So, there's a lot of firms which, there's no right and wrong with this, but the firms that we look at are the firms that have got strong recurring income, good profits, and a management team that can advise during a 2-year earn-out period. Well, if the management team has got a decent level of recurring income and profits, and it's embracing RDR, and it's got a decent, a very good compliant record, it means it's a good business and it's well managed. So we say, right, we've obviously got a good business here. We want to maintain the management team, and we allow management to retain autonomy to continue to manage that business. We're not looking to kind of change businesses that are doing well. That doesn't make sense to us. So. The business carries on as it has been doing, just with group support in various areas such as marketing and looking at areas of recurring income and costs which might be able to improve the business and make it even more profitable, and be able to offer better advice to clients. So it's 50% upfront, 25% after year 1, 25% after year 2. As long as the business continues maintaining the profitability that we acquired it on, basically.
Why did you settle on that way of doing it?
Well, I guess 50% of cash up front is attractive to the IFA practice and the management of the vendors. But holding some back with it in deferred consideration gives us a little bit of security. So if the firm doesn't perform, which generally they do perform, but if it doesn't perform, there is a kind of a clawback deferred consideration basis, so it covers us, but also is attractive to the vendor. I would say that what we've learned, I guess we knew in the first instance, really in 2008, is a good business with strong recurring income and great clients is one thing, but actually having a management team and the RIs to maintain the clients, retain the client, keep the advice to a high quality, that is just as important. So what I would say is, stating the obvious really, but when you're buying a recurring income client or a client bank or even a business, make sure that you've got the management in place, whether it's you providing that management or you're buying that management. You've got to ensure that they're tied in, incentivised, happy to continue, otherwise it doesn't work.